Hello. After a summer of turmoil on the markets and of economical and political uncertainties, the end of 2011 does not seem much more promising. Every asset class showed its weaknesses, so there would not be a better time to talk about alternative investments, which are supposed to be decorrelated from the markets. Is it so in reality? That's the question Fabrice Cuchet, Head of Alternative Management, is here to answer. Fabrice, hello.
Hello, Ingrid.
So in that environment, what are your investors expecting from you?
As you said in your introduction, clearly the environment is tough.
Yeah.
And even government bonds are not seen anymore as safe haven assets. So in this environment, investors are looking for flexibility, downside risk control, and of course they are looking for performances.
Sure, but does it really exist now?
Yeah, the good news is yes. And these three characteristics are really the characteristics of alternative investments.
Yeah, but the performances of alternative investments are being pretty disappointing in 2011.
I disagree.
You do, really?
Yeah, I disagree. If you look at indices in 2011, performance are between -3%, -4% year to date as of end of September. And it's in line with objective of hedge funds, which are supposed to deliver over the midterm performance in line with equity markets, with half of the volatility and much lower drawdowns. Nevertheless, maybe you're going to tell me that some strategies, such as long-short equities, have performed poorly this year. That's true, but others have posted very good performance either.
Yeah, but it means that you have to be on the right strategy at the right time. You can be aside from the performance if you're wrong.
Yeah, it means that you have to be diversified. So you have to mix different kind of strategies. You have to mix what I used to call all-weather strategies, like CTAs, which are really decorrelated to equity markets, which have posted good performance in 2011 and over the year before. And to mix this kind of strategies, these all-weather strategies, with more directional strategies, such as event-driven strategies. And these various strategies are really giving hedge funds a real asset, a real added value for a diversified portfolio.
Well, that's a good argument, but in reality, have you seen new inflows towards your alternative investments?
Yes, assets are recovered. If you look at the industry level, we've reached new highs at the end of June 2011 in terms of asset management industry, but the client base has a lot changed.
Who are they, those new clients?
Clearly, the bulk of the new clients, the ones who have not redeemed in 2008 and who are posting new inflows now, are long-term investors such as pension funds. And on the other hand, you've got some investors who have redeemed and who have been the bulk of redemption in 2008, such as investment banks or structured products, and they are not here anymore. So today, I really believe that the investor base is far more stable than 3 years ago.
But that's a trend that you also see inside Dexia AM.
Yes, in terms of assets, we have recovered since 2008, and in terms of performances, we are holding quite well, with more than 50% of our funds positive in 2011, and all our strategies positive over the last 3 years, since the collapse of Lehman. And so I'm very confident that our positioning, the positioning of Dexia Asset Management, is well fitted with client needs today and will help us in the future.
Well, Fabrice, thank you very much for those explanations.
Thank you.
Let's remind that for its 11th year in a row, Dexia Asset Management is now going on a roadshow to all the main cities of Europe, and the topic of that roadshow is, of course, alternative investments. Thank you for your attention and goodbye.